It's a real pleasure to have with us Jeff Auxier of the Auxier Asset Management and the portfolio manager of the Auxier Focus Fund. Welcome.
Yeah, thanks. I appreciate it.
I'm really keen to learn more about your approach. You've amassed a very impressive track record since you established the firm in 1998, I believe. But before we get to the investing part, it'd be great to just hear about your background and how you got interested in investing.
I was real lucky. When I was 11, I had this lawn mowing business, and I was mowing some of the nicer yards in Portland, Oregon, and happened to come across at the time a man named Bob Pamplin, and he actually built up the largest wood products company, Georgia Pacific, from scratch, and then he went on and became the largest denim producer in the world. So I was lucky that lawn mowing job led to some bookkeeping jobs, and then so early on I got exposed to. He took basically $100 to $3,000 over his tenure at Georgia Pacific. Then he retired at 65 and became the biggest denim producer in the world. So when you're exposed, like Warren Buffett says, choose your heroes carefully. And he was really world-class, high ethics, but just a real great investor, but a great operator as well. That kind of got me excited in my teen years, and then in 1982 I actually called Warren Buffett on a Saturday, and really he was very nice and helpful and gave me a number of books to read and actually gave me some investors to call, and then from there I just stuck to that long-term kind of price value approach.
And I guess what motivated you to set out on your own and start your own firm in the late 90s?
Probably just a passion for research, and I just wanted to dictate the culture, and I love researching, and wanted to build a firm that where we could spend more and more time researching. So I kind of believe that's like a key to be able to be focused on that research.
And you talk about aggressive research. I thought that was an interesting word to use. What does that mean, aggressive research?
Just as a risk officer, the key you've got to be as far as aggressive fact finding daily. So my commitment is a daily, rigorous approach to fact finding. So it's you're constantly covering, via the written word, not so much. Like you figure the fastest talker 70 words a minute, slowest readers 400 words. So really a dedicated researching effort is so important to protecting assets in today's global economy.
And you're based in Oregon on a farm, which is very unusual, and with your focus on research, does that help to be out there on a farm?
Well, it's funny because I asked Warren Buffett back in 1980 because I was interested in going to get an MBA, and he said, no, get as far away from Wall Street as you can and just start out researching everyone, basically. It was just, so yeah, the farm is good for humility. It's the same thing, work's got to be done, and the same thing with research is you've got to cover so much every day, and then you build that cumulative knowledge over years, and then the experience in different markets. Really, because investing is the craft of the specific, you need to know more than the public generally, and obviously legally. But to do that, years of cumulative research, it really pays off from the standpoint of adding value to returns.
I guess if we just step back for a second, and we're all here, we're in Omaha, and we're all value investors, but it's a big tent, and there are lots of different stripes. And if you could just explain a bit your approach, how do you, what's the philosophy? I know you've been talking about the power of compounding, and if you can just tell us a bit more about the philosophy.
Yeah, really what we try to be is you want to be a business analyst. You know, you look at, say, the top 25 businesses over 25 years, and you're looking at returns, at least in the U.S., of just the domestic companies, 18,000 to maybe 63,000%. So if you're a very good business analyst and you can determine what's a good business, what's a good management, what's the behavior, what's the culture, and that's what you're constantly looking for. You're kind of looking for even kind of moral dictatorship on top. You know, the leaders need to be the servants for capitalism to work. So you need, I mean, you look at Sam Walton from 1970 over the next 25 years, I think Walmart appreciated over 80,000%, you know. Jim Sinegal at Costco, high integrity, never would mark up over 14%. I think 1,600 invested in 1985 grew 800,000 today. We actually had investments before they went public in Costco. So you're looking for those kind of leaders, again, that can drive an enterprise and through capital allocation, and really kind of they're on a virtuous cycle. They're trying to make a better deal, better quality. And in today's global economy, quality is so important, you know, and even in China, they do not want knockoffs. They want quality, you know. So but you're always changing the stocks we had in the 1980s versus the 1990s, you know, versus the last decade. The key is a voracious research effort because the facts and fundamentals will drive your allocation.
And how do you generate investment ideas? You obviously very familiar with the businesses. You have a database of you know, good businesses that you want to invest in, and then wait for the price. Or talk us through where do you find, or how do you find investment ideas?
Yeah, I go through just a lot of trade journals, a lot of daily, you know, covering a lot of the day-to-day financial, you know, 7 papers a day, and then going through transcripts and just looking at, you know, trends in terms of the global trends, like global urbanization, you know, and we're in Asia, we're embarking on the, you know, the most rapid globalization in history. Well, how do you serve those markets, you know? So, and with a farming bent, I love agriculture, so we do a lot of businesses along the food chain, necessities, you know, like low ticket items, you know, people in high debt economies, it's nice to have low ticket necessities. You get, you know, coming off the debt levels we have, to expect much from the economy is hard. So you're just constantly grinding to see who's executing, what the trends are in terms of, you know, people, what are they eating? You know, you've got more protein consumption in Asia than you've got the Whole Foods phenomenon in the U.S. So it's just, again, it's the constant, you know, curiosity, or just that the search for facts, and you want to be up on those trends.
So tell us a bit more about your farm then. Is it, you know, what are the products, what's the produce there?
Yeah, it's an operating farm. We've got cattle and hazelnuts, and we actually have alfalfa. And so we see from the bottom, and a lot of our nuts have been going to China. I mean, the low-cost protein, you know, the first thing you do is you move up the chain, and as China converts more toward a consumption economy and quality, you know, nuts, we do a lot of, you know, it's really hard to pirate a nut. You know, you can pirate software, but, and then again, low cost, you got a lot of meat consumption, and so a lot of the cattle go over to Korea and what have you. So we see that side and the transportation side, and you really, again, it's coming back to, you got 7 billion people, adding 1 billion people over the next 12 to 15 years. They're going to wake up, have a cup of coffee, and, you know, the basics. If you do the basics well, you have a pretty good future generally.
And I guess how has that transpired into specific investment opportunities? Can you talk a little bit about perhaps a couple of investments that really exemplify this approach, from how you generated the idea to what piqued your interest?
Yeah, the helpful thing on a farm is you see supply and demand, and that's the thing on investing. You're always looking at supply and demand. farming, if you can just barely make a return above cost of capital, that's a good thing. But we saw, as an example, in 2009, Smithfield Foods, their debt, we were able to buy 17% yields on their senior debt. I remember buying 17% bonds at 68 cents on the dollar, then they went to 111. But we see along that chain, where the quality side of the food, and then businesses on an urbanization, you need the scale to reach those markets. So we like to fish along that food chain because, again, the necessities, you've got to keep people fed, especially in China. You've got to change in the political climate, major change, which historically have been very violent, but it helps to keep people well fed, and so that's from the farm aspect. We can see what's shipping, where we see where the timber, logs go into China, and you see the quality that people are demanding worldwide. They really want quality. In the U.S., quality branded goods are in high demand, especially in Asia.
So I guess you've been talking about you're looking for those first tier companies, if you can get them at a bargain price. And what are then how do you buy these businesses well? What are some of the situations that lead to when it comes to valuation, how do you get comfortable?
Well, a lot of things we buy, I'll track, we'll buy a lot of tracking positions, maybe a couple hundred that I'm tracking. A lot of things I've tracked for 30 years and haven't bought them, but there'll be a time when the price, and then we'll wait, and when there's a number of companies that we've followed for, 10, 15, 20 years, and then all of a sudden the price is right, but we've followed those types of businesses, and that's, and we'll buy those top to bottom. I mean, if we like processor companies, we'll buy a First Data, this is a few years ago, all the way down to an eFunds, which is credit card processor, very tiny, all the way up. Or beverages, National Beverage, which does Shasta, all the way up to a Coke or Pepsi, So we'll if we like an industry, the potential, we'll buy them bottom. We won't just buy the big ones. We'll buy all the way down to, we had pharmacy benefit. We bought Pharmacy Benefit years ago, Express Scripts, Medco, all the way down to a tiny BioScript, which is 100 million market cap on $1.5 billion in sales. So it's really, you as a business analyst, there are certain businesses we want to be in, and ideally smaller is better for size, for performance. So we'll go if the bigger companies are cheaper, we'll tend to wait more there, but if the smaller companies are better value, we'll still move it to the smaller companies.
And you talked about China and some of the important trends there, and so what is the opportunity set then? Do you invest in US listed names that are exposed to these global trends, or do you actually look in the local markets?
Well, yeah, the problem with the local markets generally has been accounting. The accounting, you look at Sino-Forest and the accounting, aggressive accounting. So, we have companies, we've been in Young Brands for several years. Again, they initially do the joint ventures and then they evolve from there. Or Diageo has been a big holding since 1989. It's not so much where they're domiciles. We want clean accounting. So, but you look at just what McDonald's has done. Their numbers, over the last 30 years, the last couple of years have been unbelievable. So you have a real emerging, aspiring class of people that with the internet, all of a sudden, envy drives a lot of people. I said, why are we living so poorly when these guys are living? And then now they can see who the bad guys are. And the internet's, disclosure with Facebook and whatever, you're cleaning up a lot of bad behavior just through the transparency. So again, if you have really good products and services that can reach out. So we like big distributions like Unilever, it was cheap because really kind of a Europe base there, but still they've got one of the widest, broadest distributions into those markets. So we'll look at that as well. But you're constantly questioning, who can reach out, who's got that quality product, and then your things are constantly evolving. So it's hard to say, it's a day-to-day transformation. Day-to-day facts are really driving the portfolio allocation.
I'm curious just to understand a bit, you really spend your time on understanding the business and the prospects for it and how it's changing. How do you go about that? Do you first look at the financial statements and do you meet with management? How do you go about the process of really improving your knowledge on companies and industries?
Yeah, well, I think, the problem with meeting management first is you've got a lot of CEOs that are great salesmen or saleswomen or basically to get to that position, a lot of times you've got to be a great salesperson. And we'd rather start with the numbers, conservative numbers, and see where the culture is and then go from there. Over the years, I've met a lot of our managers, but it's more a function. I can cover them. I like to go off the ledger, so to speak, in conservative accounting, and then start from there. Because, like I say, great managers, great. There's a lot of great salespeople out there, and but the numbers really, we like to go off the ledger. We like to drive everything off the conservative numbers,
And if I look at some of your top holdings, Philip Morris, PepsiCo, Tesco, some of the world's big brands, how do you go about getting comfortable with a brand and understanding the moat and the sustainability, durability of it?
Yeah, I think a lot of that's the cumulative knowledge. I first bought Pepsi in 1983. They had a Mexican accounting scandal, and that was the first time. So bought Philip Morris in 1982. So I've had that, and so I'm watching. But these businesses, like I say, people are focused on Southern Europe, but they're not focused on Indonesia or Malaysia, and some of the demand that's coming out of those countries. So it's a matter of following these companies for years, in my case. And that's where the advantage comes in. Typically, I don't go into something unless I've owned it for a few years, as far as buying it for the funder clients, So it is, you're always questioning, but, I'd say Philip Morris over the last 3 quarters has some of the best fundamentals in 30 years, And so you're kind of going, wow, that's amazing.
And you talk about the power of compounding and how it's underappreciated. Can you just maybe break that down for us in a specific case, whether it's Philip Morris or what sort of return do you expect to achieve by investing or holding these types of companies in your portfolio?
Well, we're always looking for the double play. So that's a low valuation business. In other words, one that the investment community is down, sells at a very low multiple of earnings, a low multiple of cash flow, strong balance sheet, but it's out of, like we talk about, we like the horrible, the bad trade, horribly out of favor. And because the news is horrible just to bad, we do really well. So we like to buy in those where the prices are bargains, and then to compound, we want the double play. Like 1983, we bought Waste Management, 9 times earnings, had all kinds of clouds over it. Their earnings more than doubled over the next 6 years. Stock went from 9 times to 40 times, and we made 9 times our money. So you need to get the double, triple play to have the margin of safety. The opposite is a torpedo, a highly valued, popular business everybody loves. It's a magnet for new capital. Comes in and they miss and you torpedo. So the key to compounding is you can't take big hits. If you go down 50%, you got to go up 100. If you're up 50% in year 1 and you're up 50 in year 2 and you're down 50 in year 3, 8% beats that. So you're always on the lookout of how can I get hurt. So we're just constantly looking at the portfolio to make sure it's compelling, compellingly priced, compelling fundamentals. There's a turn up in fundamentals. So we're trying to catch that turn, you know, when the market is down on something, but we see, oh, there's a turn, you know. A good example, a couple of years ago, Weight Watchers, it dropped down to 26. It was 8 times earnings. Market was down, forecasted flat numbers for several years. But they were doing a lot of energetic things as a management team with online initiatives and celebrity endorsements. And sure enough, their earnings went up, sales went up double digit, stock went from 26 to ultimately 80, you know. And so that's why you're just constantly grinding, looking for the turn. Because there's always something turning up and then, you know, flip side turning down. So you've got to be on those fundamentals. Gets back to, you know, it gets back to that rigorous daily research, because you got to catch the turn, but you got to make sure that price is compelling as well. You have a great company, but if it's, you know, Coke was 50 times earnings in 1998 at $80, well, the stock's it's still you had in the 70s, and that's been, you know, we sold Waste Management in 1989, and it's lower today than where we sold it in 1989. So you can have a great company, but it doesn't mean you'll make money in the stock.
So is it these companies that fall on hard times that the market assumes that these hard times will persist, and based on your research you think they're more temporary, and that's the opportunity? They
have to be temporary and fixable. I mean, you can have a situation like the digital age wiping out the bookstores, you know, you've got to look and determine if it's a permanent impairment or if it's temporary, fixable. And that's kind of the tough part. You need to see if, you know, can you come back from this? I mean, you know, there are just so many cases. I mean, look at Circuit City, or look at Best Buy, look at just the transformation of the internet. The internet's a net profit destroyer. So you really have to be on high alert, because there's a lot of ways. I mean, look at Eastman Kodak. I mean, who would have thought in a knowledge-based economy that you're going to be hard-pressed to be able to buy a book in the next 5 years, an actual physical book, you know? Who would have predicted that, right?
Yeah, I guess it's fascinating to follow the life cycle of some of these companies. And I guess the question is really what, it's so easy to say, well, looking for, you know, figuring out whether these difficulties are permanent or temporary. Can you give us some insight into, you know, what helps you make that decision?
A lot of it just has to do with, you know, historically watching. You know, it's like in 1983 they had 30 or 40 new initial public offering or IPOs in personal computers, right? Virtually today you can't hardly find one that's left. So you see there's certain enduring type qualities in businesses, and then there's others that generally technology, it's been better to rent those than to buy and hold those, you know. So you're kind of trying to determine, you know, the consistency of demand for those products. And that's the trick. You're trying to determine, you know, and then same thing, you've got to start with the balance sheet and the accounting and what have you. And because without a good balance sheet, it's very difficult to endure. And so a lot of it's the nature of the product and the commitment to continue to build. Is a management, do they love the business, or are they in it for money, you know? And so there's so many factors. There's not just one. You're looking at a whole number of factors. You got to look at the balance sheet. You can't just look at a price earnings ratio because, or a dividend, because the banks in 2008, they were all borrowing to pay their dividends, you know. So things are always changing, but you've got to determine, can this problem be fixed and can they recover, you know, or is it just, is it hopeless? And I mean, look at newspapers and look at what's evolved there in terms of that digital transformation has been very painful.
And the reinvestment decision is so important for some of the businesses that you own, the allocation of capital, and management is so key for that. I guess, again, what what are some of the factors that make you comfortable with a management team, and are there any red flags when you see management saying certain things or doing certain things that you get cautious?
Yeah, you're always looking at, things like ego, overpaying and overborrowing. And you watch that. I mean, companies over and over destroy their franchises by overpaying and overborrowing, and then buying their stock back at price levels that don't make sense, So you really want to be we're very much price sensitive when allocations are made. What are they paying? And if they don't have that orientation, it's very easy. Look at what happened to Weyerhaeuser. The combination of a powerful ego with overpaying for a number of businesses just totally transformed that industry, that business. So you just have to monitor those management actions and look to see the heart and soul of that manager. Are they truly a servant like a Jim Sinegal of Costco? Are they or Sam Walton? Are they trying to get a better deal for their customer, or are they trying to, like Wall Street was taking advantage of their customers, and what happens? You don't endure. Unless you take care of your customer, you're just not going to endure. So you need that culture of getting better value for somebody, we talk about the moral dictator constantly driving that business for what's right for the business, not to go to the trough and indulge in, stock options and, that kind of thing on a short-term basis.
And you live on a farm, and it's an asset you can see. It's a hard asset. I'm wondering, some of these businesses, you got to evaluate brands, intangible assets, and can you tell us a bit about how do you look at these different types of businesses, capital light versus capital heavy, and
yeah, we do ideally like businesses that don't require a lot of capital, because if you do get into inflationary times, it gets very expensive, and we prefer businesses that continue to work on the quality of their product, but it doesn't require huge amounts of capital. So that, when you're comparing the financial flexibility of businesses that require less capital is very attractive, So by nature, most of ours have real high free cash flow yields and the ability to raise. We want to be companies that have the ability to continue to raise, the cash payouts.
So is that one of your favorite valuation metrics, then, the free cash flow?
Yeah, we like high free cash flow yields, high returns on invested capital, and then companies that continually build their brands. Because we think in today's global environment, brand quality, with all the transparency, people can tell if you're taking shortcuts. So we'd rather have the business build that brand even than buy their stock back, at a fairly valued. Unless the stock's really a bargain, we'd rather have them build that brand and build the customer experience. I mean, you look at what Coach has done, as far as, and what they've done in China, and just, they build a quality, and that's that quality brand. People want that globally. Look at what Starbucks has done in Asia already. They just, you could argue a lot of people can't even afford their coffee, but they're still gravitating toward a brand that is perceived to have quality.
I guess the other thing is, you mentioned the internet and how it can be destructive. I guess brand proliferation is also an issue in this online world, where in some industries there seem to be so many so-called brands, and how do you distinguish, I guess, from an enduring brand and versus some of these more, they're also brands, just I guess their brands come in different varieties, and can you give us some insight into that?
Yeah, I think, you know, the brand needs to have a heart and soul behind it. Or, you know, Nike's done it through a lot of, you know, great athletes, you know. And so there's got to be an identification that this is a trusted, quality brand, and people, like I say, need to see that, you know, they stand behind the brand. It's just not some private equity play. You know, it's like there's a heart and soul behind that brand. And I think that's the way the product flows are going globally now. People want to see, you know, they don't want, like we're talking about in China, they don't want the knockoffs now. They want, you know, they want someone to stand behind. That's why I think a lot of times, you know, a good CEO who's driven to better the brand, better the quality for the customer, and people, they want that accountability. You know, we call it a choke factor in investing. You know, we want, you know, our investors to think, hey, they can choke me because I'm behind the numbers, instead of having some committee that no one can figure out who's doing what. It's like, no, that's the person you can blame, and, you know, if you have a problem, go to, you know. I think that's what's missing in a lot of these companies, where they don't have a clear identification of what they stand for.
And can you talk a bit about some of these, I guess, local brands? Have you come across, you mentioned the accounting is a big challenge there, but are you aware of some local brands that could really grow and become some of these big brands, or are you content to stick with the established brands and just wait for a good time to buy them?
Oh, you know, we're watching. Yeah, you look at what's evolved in, you know, like some of the energy drinks and Monster and what have you. So you're always looking, and those are just, they tend to be much more aggressive. So you might buy a smaller percentage in that, and knowing that. But yeah, there are businesses out there that, you know, like I say, ideally you want the smaller business that's got a longer record and that, you know, is executing, and you're going to do far better. But you're kind of looking. I mean, look at what Chipotle's done with just very high quality ingredients, or Panera Bread, or, you know. But those are typically something we're not going to take a big bet on. We might take smaller bets, and if it grows into a bigger position, you know, just by nature, they're pretty highly valued. But that's kind of what's happening domestically. You see Whole Foods, what they're doing. Those are typically not priced for our taste, but, you know, if they stumble, you know, we could be there.
And you mentioned Diageo. I'm curious in terms of the brands. It seems in the beverage industry, it's the barriers to entry are maybe not that high always. If you look at vodka, for example, some of these brands that just come out of nowhere, and you know, do you think some industries are more open to new brands, and which ones would those be?
Yeah, I just think that, yeah, the companies, you look at what the transformation in a lot of those beverages, you know, I mean, it's amazing what is going on. But I think it does help to have a distribution in place. And like we have Molson Coors, it's the largest brewer in North America, and, you know, the management's doing some innovative things, you know, and they've got the craft beers and what have you. So you want that management that's in touch with the market, trying to, and I think as people go on in this whole nutrition and the idea of depletion of minerals and what have you, in terms of the diseases, and I think that's where you're starting to see the Whole Foods in terms of people are trying to understand what damages, you know, processed foods do. I mean, so there's definitely an evolution, and you're seeing the businesses that are providing quality ingredients are really outperforming, you know. So that's a trend that looks like it will continue.
And a lot of value investors are attracted to Nokia at recent prices, and some would argue, well, it has a a well-known brand, has global distribution. How would you approach a situation like Nokia?
We bought Nokia before it was a phone company. That's how long I've had Nokia. But we bought it, adjusted for splits, $2. Went to 50. We sold half of it there, and dropped to 40. We sold half of that half, and then went to 30, and we continued. So we had reduced the position pretty materially. And it's an interesting, I mean, people don't realize Apple was just about done. They were about bankrupt there. And so Nokia, if they can team up with Microsoft and come up with a decent, phone. But there's a case where people are paying for design, Apple's quality product that executes. They're willing to pay for something that's very user-friendly. And, Nokia's got a lot of cheap phones, right? I mean, a lot cheaper, but, is it the quality, the consumer? So you have Apple driving the market, saying, look, you guys need this. We're gonna make it so user-friendly. And people go, oh, I understand. And Nokia has to take the same approach and say, we're gonna build this great quality product. Steve Jobs was just adamant about quality product, cut boot times, in that whole focus. Here you get the highest value company in the world based on build a quality product, And I think if Nokia can come out with, with this partnership with Microsoft, they easily could turn that, But it all depends on the quality of that product in the perception of the users. Because right now in today's world, if you got a quality product, you can get, you look at what Chipotle's done in terms of building value. And so Nokia is an interesting, but it's an interesting spec at this point.
It sounds like you're still on the fence a bit about.
Yeah, I just have a huge respect. There's so much capital going into that space, and you look at Samsung, and you've got Samsung and Apple are spending $400 million, I think, already just on patent wars, and it's going to be a brutal, and that's just we don't like that much competition. We want something that's a little more mundane.
And perhaps we could talk a little bit about the circle of competence that Warren Buffett talks about, and you didn't mention it with Nokia or technology. Are you comfortable in principle with that space? And I know you invest in Microsoft, and where do you feel more comfortable? What lies outside your circle?
Yeah, not real comfortable with technologies from the standpoint. Some of those, like an Intel and Microsoft, just from the standpoint in the Northwest, and we have pretty good access to information, but just on a price to cash flow basis, and just the strength of that franchise and that price, it was a little more of a price arbitrage than necessarily a buy and hold. But some of the new products and what have you in the cloud, and they've actually been executing operationally, and then just at that price, but not our favorite area, just because, again, the way technology evolves. I mean, I remember watching Burroughs and Sperry Rand, Compaq, and it's very tough to make money consistently. Now, where we do like technology is where, like, we have Visa and MasterCard. Well, I mean, they're users of technology. We like processor companies. They're users, and we had a lot of First Data before it was taken over, but they're a beneficiary of all this technology prices. The price is coming down, but we're not that comfortable with direct ownership in that space because it changes too fast, and you can just look at how fast Cisco dropped, and just back in the early part of the decade. So no, I study. It's just very humbling. It's I don't want to bet big in that space. So we have some special situations. I mean, Microsoft's worked out, but we're typically not going to have a portfolio that's overweighted ever in technology.
And looking at some of the really challenged industries, housing in the U.S., financials, do you see any opportunities there? Any really good businesses that stand out and they're going to survive?
Yeah, normally, like in the last thrift crisis in the 1990s, we were very aggressive buying a lot of small, mid-sized banks, a lot of regionals, and because the Resolution Trust came along and they pretty much took out, a lot of the supply. They pooled the bad loans and then they kind of took that supply. Right now, we're still muzzling with all kinds of housing subsidies and $400 billion a year, and the government is just, when the government is basically socialized interest rates. I mean, they've repressed these rates. The problem is when the government forces rates down, they're masking the underlying, the balance sheet of the U.S. government is deteriorating. Normally, in a free market, those interest rates will go up to reflect the deterioration. In our case, we've had a deteriorating balance sheet, but the bond market's locked up because the government's buying 65% of the issuance. So you can't get a read there, and that's the problem with the housing market. You're not clearing that. The market's slow to clear. It's finally starting to clear, but wherever the market is not allowed to function, Japan, their real estate, I think their housing went down 17 years in a row, because they're not coming clean in Japan in terms of the banks realizing the problem. So generally, as a nation, the U.S. is pretty good about that. But if you when you've got subsidy after subsidy, and it's that old, that easy money is robbed so many years. And usually post bubble, I mean, when you go back, we've had 35 bubbles, I think, in a couple hundred years, and post bubble is very tough. Once you break the bubble burst, you tend to bounce around, but it's been 11 years for technology that's kind of bouncing around. It's when you rob the future with easy money, very tough. So it's hard on the odds. I mean, there's some regionals we have, but we aren't anywhere near as heavy as we were after the 1989 to 91 thrift crisis.
It sounds you may be also concerned a bit about inflation. Is that also driving potential inflation down the road as a result of the artificially low interest rates?
Well, I think a bigger risk is the balance sheet problems with the liabilities, the pension liabilities. I mean, look at Greece. Rates went from 3 to over 100%, and you've got balance sheet issues in Europe driving rates up. There's different ways you can get hurt on bonds, and we have so much slack in our. I mean, I think less than 60% of Americans are actually working or in the working pool. So we have a lot of slack. Where we're seeing the risk of inflation is more of a Weimar Republic type of post World War I. The debts are so large they just print and print and print. So it's more of a QE3 or 4 or 5. I mean, the printing press, you're debasing every time you print. So again, and when you do that, you're just masking the underlying deterioration, and you're not restructuring. Kind of like what's going on in Europe. You're just, one country's left that wants to restructure. Everybody else just wants to print their way out. Germany's, they're the only one really that they're trying to, hold the fort, but it's, there's just, it's amazing how, it's, you're just constantly, and then creeping socialism out of France, that's an issue, and then you've got, but then you go back to Indonesia, Malaysia, and some of those are really exciting stories, in India, the work ethics there, and generally if the population works hard, they're honest, they pay their taxes, they're save, you do well. It's just when people like in Greece cheat on their taxes, they want to work less, they're entitled. The global market is just chewing them up, where you're free to compete, and they're, those who are competing they're rising up, but that's the price you pay in a global economy. You better be willing to really bust your tail, because
And in this world, then, to preserve purchasing power, I guess you've opted for some of the great businesses that you can buy at a good price and protect yourself that way with the pricing power, or the farmland. I'm curious, do you think that should be in everyone's portfolio, a bit of real assets? And
well, I love farming just because I just like I love agriculture, and just it's it's something that the U.S. does really well comparatively globally. But it's very humbling. I've followed that. I've lived on the farm since 1988, and I've followed. I've looked at every aspect of it, and it's very humbling. And I would be, if you're not in it, it's very dangerous. It's very capital intensive. Typically you sell your product once a year. The inputs constantly go up, and the end product of your you don't know. And you've got foreign countries, and they may subsidize, and very tough. So, no, farming is not an easy way to make it. Trust me, it's talk to my son, my kids, it's not, I know there's, Jim Rogers has been pounding the table and what have you, and I would agree there's a supply-demand imbalance. Your average farmer's getting older, but it's still, we've got a ranch, and we've got a neighbor, and I was talking to him, and I said, well, in 36 years, he's never taken a vacation. In 36 years. So that gives you an idea of the tenacity of, I think it's a good training ground, but, to think you're gonna, it's between the regulations and, the environmental movement, and there's a lot of variables, but it's a great lifestyle for your family. It's tremendous to see. I like watching toil, but it's definitely year-round toil. It's not, So from an investment standpoint, I'm a little. Again, if you look at the extent, the commodity bubble or boom lasted through last summer was 115 months. Prior to that, the tech, telecom, media boom lasted 13 or 14 months, and then the housing boom lasted about 114 months. So we're late in that cycle. When you start securitizing, bundling, and liquefying, you got to be careful, But I think generally, if you make a great quality, necessity type product, that people, that demand is going to be pretty constant, But the key is if you're a quality supplier, and you're all about quality, you'll do fine. But the effort it takes in farming to do that, you got to be dedicated,
So it sounds like with a lot of capital flowing into farm and cropland globally, there is some disappointment waiting to happen in terms of returns.
Well, the flows nowadays, the global flows of capital, anything. Look at what they've done in natural gas. The technology of fracturing and horizontal drilling. We've got a 100-year supply here, 250-year supply globally, and we've doubled oil production out of the Bakken and all that since 2008. So we can produce. That's not the problem. The problem is, and you can really produce. And our farmers, we know how to produce. We can get the production. The question is, is there a return? And that's, that's the hard part, because your inputs continue to escalate, and then what will the consumer pay? So you've got to have a very powerful brand together, and so really the branded businesses, they tend to do better than the raw commodity farmer.
But then in natural gas also, do you see opportunities there? It's hard to have a brand there.
Well, yeah.
Than maybe some of the some parts of the value chain?
Yeah, very tough. I mean, we have played that with, big users of natural gas. We'd rather, I think between oil and gas, you could, if you change administrations, you could have oil back to $9 a barrel. I mean, George Bush, when he opened drilling up in 1999, I mean, you saw oil drop to 9. I mean, there is the technology is there to really outproduce. And do you want to be and I've seen that back in the 80s. We bought producers after we bought Schlumberger. It dropped from like 90 to 32 in 1985, and that stock went up maybe $4 in the next 5 years. So you got to be very careful when there's potential supply. And so you had OPEC here, and now because of the high prices, you've developed a technology that basically can knock that OPEC monopoly out. And you still have, Iraq, oil out of Iraq, and you've got fracking technology again with oil, and so it's very. So we want predictability in our. That's too hard to predict. So I don't like to go if I can't tell the odds. I don't like to. It's. Now again, you could get prices so cheap but generally I'd rather have a business that turns inventories over frequently than with the necessity type product.
What do you think? We haven't really talked about investing mistakes. I'm curious if you could share with us maybe some that you've made in the past and.
Yeah, a lot of times the mistakes, you might be in a position where you've got a really good CEO and then, almost a founder type CEO, and then they leave and that culture changes and not selling or not lightening up their, the mistakes would be generally, I'm just thinking over the years, when you probably totally eliminating financials before 2008. We cut back severely, pretty dramatically, but we didn't take them totally out, but in not following conviction. And then when management starts making very poor acquisitions and overpaying, over borrowing, and so. But generally speaking, we've been pretty good in terms of protecting. In other words, in the down markets, we that's when we outperform. So we'll generally our mistakes will be not being aggressive enough in a nut market, but we accept that because. Like we talked about the torpedoes, once things turn, you can't really get out, and so. But I would say mistakes would be, from lack of research effort. But our research effort has been stronger today than it's been any time, But you just, you're always making mistakes, though. You have to have the humility to prepare, and I think the mistakes come again. We talk about if your ego, if you're thinking. Oh, I'm really good, therefore I don't have to do that extra research,
What goals do you have for your firm? You live on the farm. What is sort of in 10, 20 years time? What are your goals?
Well, we just want to, people have entrusted us with their money, so we want to give them the highest risk-adjusted return. So we figure we'll grow. By trying to be the best capital allocators, not necessarily the biggest or not if you can master capital allocation and you can help a lot of people, we're not really after getting bigger just to get bigger. We'd rather have exceptional numbers, and we've been able to outperform the market since '99. We're over 100% over the market, but really, for me, the devastation is if someone trusts you and you betray the trust, So it's not so much about getting huge; it's about how are you performing versus benchmarks, and how are you taking someone's hard-earned savings? How are you treating that and growing it?
You mentioned some of the role models that you have and got exposed to early on. I'm curious if you could perhaps give some advice to people who are starting out in the business, and some of the resources or books that one should study. Everybody looks to, or a lot of people seem to look to Wall Street, to these traditional ways of getting into investing and finance. What would you recommend?
Oh, I would find just an area that you really like in the business, my passion has been research all from day one, so everyone's different, and so you want to find an area where you can add value, that you'll willingly work, that you like to do enough to where you could do it 80 hours a week, so everyone's different, and you just have to find your passion in that space. But it starts with that high grade ethics, and then you got to be on a mission to really master whatever game you're in. So my goal has always been to master the game. It hasn't been, everything else follows that. So it's just you got to have a long-term orientation, and you've got to. Once you master something, everything else falls into place. But if you're not, like I say, today's global economy, if you're not putting out an exceptional product or service, so it's got to be a product you're passionate about, you'll stand behind it, and if it's investing, and that goes with research, it's just mandatory if you're going to be a great investor that you are a voracious learning machine. So it's kind of those areas that you really, and that's just it's the passion, because the passion will flow through it. People realize you're on a mission and you're passionate. You're not in it for a quick dollar. Then that quality flows through.
Great. Well, on that note, Jeff, thank you so much for your time.